So, welcome to the Real Estate Brief. I'm Adam, and today we're cutting through the noise. We're going to get to the truth in the news. We're going to look at the data, and I'm going to give you some of my observations and where I believe you can find opportunity. So, if you're ready to gain your real estate edge, let's dive into our very first story. And this very first story is going to come from us by RIS Media, Risk Media, rismedia.com. It does require a pay to get behind the paywall for their news articles. But look, I'm not affiliate of them, but if you are interested in the housing industry and real estate specifically as a real estate agent, they're a great source. Them and Inman, they have great articles in there to kind of talk about the market. They don't go into too much hype. So there's just a little bit of a plug for RS Media, if you will. But this article here is basically talking about baby boomers. I mean, in essence, that's exactly what it's talking about. It says the silent shift, how baby boomers are quietly reshaping the real estate relocation market. The subheading says, this wave of moves requires more personalized and thoughtful support than a typical transaction. Decisions are usually made as a family with adult children heavily involved in planning, advocating, and providing reassurance. So there's a lot kind of in there. So we're going to break that down. And really, when you start hearing about the silent market, it's in regards to the baby boomers that are just not really making a big loud announcing like, hey, we're moving and we're here. And it's more of this like slow trickle of properties. So what's happening is the baby boomers are beginning to move. And when I say move, they're not massively putting their homes on the market and flooding the market with new inventory. They're being more strategic in the way they do that. And they're also being way more strategic when it comes to how they reallocate their equity that they have in their home. There's really not a sense of urgency that's there. But at the same time, if you've been following me at all, you've heard about the lock-in effect and what that means. And in some ways, the baby boomer, that marketing sector is defying that lock-in effect. Because the lock-in effect is paralyzing some of your younger generations that bought maybe back in 2019, 21, and all the way into 2022 because they have a low interest rate. The baby boomers are finding themselves in a little bit of a unique position because most of them, not all, but most of them have mortgages that are paid way down. So they have a big chunk of equity, whereas if they were downsizing, they could roll that over into something else. And at the same time, they maybe even have enough equity to go out and buy something and not have any mortgage at all. Therefore, the interest rate is not a factor for them. But they're really smart. They've bought and sold houses many times, and they're not just dumping their homes at a quick urgency. So that's what this article is going to be talking about. So let's go ahead and jump into this very first article. All right, it begins. This is this is commentary by Mindy Cook, March 13th, 2026 at 1 p.m. It says baby boomers, roughly 20% of the U.S. population. So that's a big chunk of the population. 20% is huge. And then this is the bigger number. It says they control about 41% of America's real estate assets and a major share of housing inventory, creating a generational supply squeeze that has lasted for years. Now, it'll unpack this just a little bit for us, but when you start factoring, it's almost a 50%. We're at 41%. The baby boomers have control of that amount of real estate. So what we're seeing though, and this is where this article is going to get to, is like this, as these baby boomers are aging up, they are not needing the homes that they have probably lived in for 30, 40 years. So there's new homes, new inventory coming onto the market that quite frankly, we've not actually seen on the market in 30, 40 years. So that's the whole point. It says this huge pool of long-held homes has stayed off the market as owners delayed downsizing and chose to age in place. Now, relocation teams and agents across the country are seeing more late-life moves from boomers. These are not about chasing dream retirements or lifestyle perks. Instead, they are driven by practical reasons, and this is the key. What if you're going to talk to baby boomers, how do you talk to them and get them to move into putting their home on the market? So these are the keys. It says they're looking at getting closer to adult children for hands-on help. They're looking for better access to healthcare and stronger family support networks. So that's the driving factor that these baby boomers, as they age, are looking for a way to downsize to some degree, but more importantly, getting closer to their adult children's as they age. So keep that in mind when we're talking about marketing and the opportunity that we find inside of this generation. And don't forget the number. 41% of the boomer population controls the real estate market. 41%. It's a lot. It says many in this generation already lived out their retirement dreams right where they were, whether in their primary family home, a favorite summer spot, or that long-planned retirement property. They have stayed put for longer than expected, enjoying familiar surroundings and independence. But as health needs change, mobility becomes more difficult, or daily life requires more assistance, these homeowners are now making thoughtful relocations. So these are not rushed sales. If you're talking to a baby boomer and you're breaking down their home, you're talking about value, that kind of stuff, they're not rushing out the door. They're just beginning to analyze and process the idea of downsizing and moving closer to family. There is zero urgency here, right? Most of them have their home paid off, and if they don't have it paid off, they have a very small mortgage, and they're financially fine. So they're not sitting here like, we got to dump this now. There's a financial, we're in distress. There's none of that. That's not what we're talking about. So there's not a rush there. So when you're approaching, you're talking about their home and trying to help them navigate getting their home on the market. It's really about focusing on how it's going to improve their current state, their life. It has nothing to do really with the financial part of it as much. It has everything to do with just their life, like where they're heading in the next 5, 10, 15 years. So it's talking through that with them, right? All right. It says the outcome is a steady, controlled release of long-held inventory into the market, predictable rather than a sudden flood. From an inventory and supply standpoint, that makes a significant difference. It unlocks homes without the market disruption some people worried about while reshaping how and where properties become available. In other words, we're not going to see a big influx of inventory hit the market because of this generation and the situation we find ourselves in. And that means we're not going to be tilting that economic scale too much one way or the other. It's more of just a consistent trickle. And let me just say this, is if you are an agent and you are trying to figure out a niche market, and I don't know if I got into this today or not, but right now, the average millennial, the average new home buyer is in their 40s. Okay, so if you're thinking about new home buyer being in their 20s or 30s, you're aiming too low. It's more in their 40s, and that's because of the cash heaviness. And that demographic, that generation, is a really small one. So sure, you can niche down that small going to the 40, but look what we're talking about here. We're talking about the baby boomers. If you can position yourself into that niche market as understanding what boomers are looking for when they are selling their home and understand the intricate details about relocation, like to be honest, like in our company, we have a relocation department. This is where that department is going to probably accelerate in business because most of these boomers, and we'll probably get into that, they are relocating to new environments. So if you're in a brokerage that has a relocation department, you need to be working towards being a part of that and do what needs to be done. Yeah, it comes with fees, and comes with referral fees and that kind of stuff. But the reality is it's a trickling type of business. So it's a consistent set of business, and you're dealing with people with cash. So this whole financial situation, the difficulty of that, it kind of goes away. So these transactions you get become a little bit easier when you're dealing with people with cash and good credit. So just keep that in mind. If you're trying to think about niching down, this is a demographic that is very, very large, and we're at the cusp of that breaking loose. So, food for thought. This is person as a relocation director at Huntington and Ellis. I handle national and international broker referrals across dozens of markets. In the past year alone, I have had more than 300 conversations with relocating clients, and a growing number involve adult children organizing moves for parents in their 60s and 70s. So that's interesting too, is the kids are actively involved in helping their parents move. And there's a really simple reason why. Most baby boomers have aged in place. They bought a house maybe back in the 70s and 80s, some maybe in the 90s, but right in that window, and they've not moved. They've lived in that house that entire time. So two things. One is that's a good niche, and actually more than two things, but the other one is the kids are the ones we want to be engaging with as well. We need to be very aware of that generation that's actually helping their parents navigate that complex move, because a lot of them have accumulated a lot of stuff. They've cluttered up their houses, and there's just a lot to deal with. So they require their kids getting involved. So keep this in mind. All right. It says the pattern we see is consistent. Decades-long ownership in the same property, just mentioned that. Decisions driven primarily by family support needs. That's where they're aging out, right? They need support, they need help. Multi-state or multi-region coordination. So this is the whole point, is to get in on this niche, you got to be involved in some kind of relocation situation. Because that's what's happening is these relocation departments and almost every brokerage is ramping up their marketing to get themselves in front of more and more eyes of those that are relocating. And that's going to be a big business in the next few years. This is going to be a very, very big business because we're now going to address in that 41% that we talked about before, right? It says these moves take more time and are more complex than a standard buy and sell transaction. They include emotional considerations, detailed logistics, estate sales, and input from multiple family members. Still, together, they create a real measured addition to inventory. Slower than typical transactions, but meaningful for overall supply. And a large demographic, right? A large pool of properties. All right, we'll skip on down. It says younger generations, including millennials, Gen X, and some members of Generation Z, are moving in for jobs in healthcare, construction, sports, hospitality, and other growing sectors. Affordability and family connections keep Las Vegas growth strong, helping maintain demand and keep the market active. I didn't read it, but they were comparing Las Vegas, kind of using it as an example. It says the result is not a dramatic exodus or price drop. It is a steady movement. Long-held homes enter the market gradually as owners make intentional changes, and younger buyers are able to take advantage as inventory opens up in a balanced way. So this is kind of bridging that gap a little bit of that affordability gap for the other generations as well, because you're going to get more homes on the market that might need a little bit more work because they're a little bit dated. So the younger generation could come in and buy those. So it also kind of helps that affordability gap there, hopefully, as this pans out. We'll see how that goes. It goes on to say relocation is no longer a support function. This wave of moves requires more personalized and thoughtful support than a typical transaction. It often involves coordinated agents across states, addressing tax and estate considerations, evaluating healthcare options, and navigating the emotions of leaving a home filled with memories and years of retirement enjoyment. Decisions are usually made as a family, with adult children heavily involved in planning, advocating, and providing reassurance. So there's a lot there. This is not going to be just your quick sale sometimes. Like, it's going to require a lot of work as far as getting the home ready and kind of helping people through that process. That's fine. But just know it's a little bit of a slower type transaction. But again, a very large one. All right. It says the shift. Baby boomers are not leaving the housing market. They are engaging with it in a new way. This change, driven by demographics, longer lifespans, and evolving family patterns, will, and it goes on to say this, gradually release tightly held inventory. In other words, those that have just not been on the market, 30, 40 years even, right? We're going to see new homes. You think about areas in your area, and this actually is probably where, let's just pause for just a second. You know, I'm a big fan of farming and connecting and relationship building, that kind of stuff. Like, if you want to grow a business, it's getting in front of the people. The marketing, stuff like that, social media, all that kind of stuff has a place, but it's a very small one. It does very little. It piggybacks off of the in-person conversation that you're having. That's where the true marketing begins. So I'm a big fan of circle prospecting. That's a whole nother video. Farming, that kind of stuff. Going after expired listings, all that. That's all good. But the biggest thing is like honing into areas in your subdivisions around you that maybe were built in the 80s and 90s, and pulling up PBA public record and seeing how long those owners have owned those homes. And then you can get some really good data there. And there's a lot of programs out there now built inside of MLSs even that can help you do some data mining to find the opportunity here. And so if we know that the baby boomers are the ones that are gradually releasing the tightly held inventory that we've not seen in a long time, if we know that's what's happening, then it's not hard to figure out where those homes are going to be coming from, because we're going to go into subdivisions that are, 50, 60 years old. They've lived there that long, and pulling those records up and finding those homes and canvassing those subdivisions. So this obviously comes with a little bit more specialty to understand that nuances of how to help the baby boomers navigate this. But for the agents that build up a good contact database that has, a good financial planner, a good lender, all the type of stuff that we need to be able to help them navigate that, maybe some movers, that kind of stuff, it would help this. So just keep that in mind. This is a great demographic and very easy to target, to be honest. Shift demand toward areas near family and strong support systems. They increase cross-state and multi-generational transactions, and then they elevate relocation to a key strategic service rather than a secondary function. And that's typical. For many years, relocation departments and relocation inside of brokerages has just kind of always been that secondary function in agents' minds. It's almost just been like, yeah, I'll be a part of that and I'll get what I can from that. But man, I don't have to pay the referral fees and lose all that money and all that kind of stuff. The reality is, I would 100% agree with this. We're seeing this in our own company right now. And our relocation department is repping up big time. And it's because that this baby boomers are trickling those properties out and beginning to do these moves. So that's why it's a very good strategic service. So here's the reality. And I don't try to tell agents where to kind of put their license, that kind of stuff. But one thing I would say is if you are a new agent going out there looking for a place to hang your license, understand that now, I do think you need to find a brokerage that has a relocation department. I think you need to find a company that is relocation minded because that is a pool of leads. Now, one other thing to keep in mind though, is you can't be a new agent and just immediately go into the relocation industry. It does require certain criteria. You got to have some experience, you got to have some sales, all of that. And then your broker has to sign off on that. Most of the time, though, the relocation departments don't get the final say. Like the broker and the relocation department of that brokerage does not get the final say if you get to be a part of that team. You have to fill out applications, submit that to relocation, companies, that kind of stuff, and they accept or not. So, but there are certain minimum requirements to get involved in this. So I would say get started now, start studying now, start canvassing those areas to get listings in that area. Because if you can canvas those areas and make sales and hone in on that niche, then you'll get the sales, you'll get the experience, and you'll also be dealing with relocating agents that are bringing those relocation clients into the homes that you have listed. And your name will be on those contracts, dealing with the relocation companies. And then when you come to start filling out applications for them, you're going to look really good on paper. So this is just simple advice I would give you is like lean into this. I think it's a great opportunity. I'm telling you right now, if I was actively in sales, I would be doing this. I would be targeting the baby boomers, going after the relocations because it's ramping up pretty fast right now because of the relocating of the boomers. They're not staying in their cities, guys. They're going from the city they live in and they're moving across states and different cities to go back where adult children are to help them get taken care of. This is the shift for the next 5, 10, 15, 20 years. So massive opportunity here. It says, this is not a short-term trend tied to interest rates or market cycles. It is a lasting demographic shift shaped by how people are living longer and where families are settling. In a real estate industry that often emphasizes speed and volume, the next wave of inventory movement will reward professionals who prioritize patience, coordination, trust, and client-first approach. I'm going to pause here. If you go out there and you start marketing this right now, don't forget where you heard it first. I'm telling you, like this is the future. Like this is the largest. Go back to the very beginning of this article. 41% of the housing inventory is owned and controlled by baby boomers. 41%. They are beginning to age out and downsize or relocate. Pretty simple, right? I mean, especially if you start factoring in that the average first-time home buyer now is in their 40s. That means that demographic is really small because that affordability gap is so large. So you heard it here first, guys. Maybe you probably heard it somewhere else, but at least I'm dissecting it. I'm just calling it now. I'm calling it now. Baby boomers. It's the next big niche. It's the best niche to get into right now. Do everything you can to focus on them. All right, so I kind of gave you a lot of the action steps as we were kind of breaking this out. It's recorded. Go back and watch it. Go back and check out all my little action points that I encourage you to do. I would go into subdivisions. I would find the homes built in the 70s and 80s, pull public record up, find the ones that have been owned by the same person for 20, 30, 40, 50 years, and start marketing that subdivision because that's where some gold's at, baby. That's where it's at. All right. With that being said, let's go into our next article here. That was a long one. I almost talked about that one for 30 minutes. That's awesome. Oh man, I like to talk. All right, here we go. This next one is this next one is by Inman, and it's titled Better Claims, and this is better.com. And I'll briefly talk about what better.com is, and then we'll get into the article. But better.com. claims its new AI app can underwrite some mortgage loans in 47 seconds. 47 seconds. So very fascinating, but also we need to dissect this just a little bit because there's all kinds of AI going on out there. I mean, matter of fact, I was just talking to a friend and he was talking about, did you see this on X where the someone had posted on there talking about they went and bought and sold at their entire real estate experience just using AI alone. And, you know, it was kind of funny as everybody, even in the comments was like, wow, impressive, but risky, right? And it's because, yeah, on that surface, everything went great. I like to hear the other stories because when things go bad in a deal, who's there to help you navigate that one? You know, again, all these AI and tech companies fail to realize the most important factor in the whole transaction is the human element, because the human element can show empathy that technology cannot show. It can understand the nuances about what people need, and AI can't do that. Like you're just not going to replace that going and connecting with people. We still crave it, you know. I mean, you still want to be around people. I mean, if the pandemic didn't show you that, then you're lost, because like we want to be associated with people. We want to have conversations. I want to be able to talk to people about my situation and things I'm going through and get advice. Like that's just AI is going to replace some things. Don't get me wrong. It's just not going to replace the human element. It's just not going to do it. We're human. We're always going to crave it. Anyway, so let's get into this. And really what's happening here is Better.com is making a lot of headlines because they're claiming that their AI can underwrite these loans in less than a minute. Now, if this is true, to some degree, that would be a game changer when it comes to processing loans to closing. Now, we're not talking about lenders. We're talking about behind the scenes, right? The underwriting of the loan, the checks and balances of originating the loan, right? We're not talking about the gathering data, the lender, and that kind of stuff. We're talking about the behind the scenes stuff, the underwriting process, right? So it does sound great, but again, it raises a lot of questions. It's kind of in the headline, 47 seconds, right? So is speed a substitute for certainty, right? Because speed is one factor, but then do you have certainty that the speed is going to answer the question? So that would be my polar opposites here. Cassie, thank you for the rose on TikTok. Thank you so much. Appreciate that. That's great. All right, so let's quickly, before I get into the actual article, this is Better.com. Okay, Better.com, it says, ask Betsy AI, the industry's first AI mortgage advisor, and it's Better.com. They have a few tabs on the top here. It says buy, it says apply now, purchase rates, affordability calculator. They got all the calculators you want to see. They have refinance options built in. They have home equity where you can apply now, calculate your cash, HELOC versus cash out refinance, learning center. So there's a lot of resources on this, right? Fascinating actually. So far I've not seen actual cost. All right, it says purchase mortgage rates, refinance rates. Okay, so then you have Better Plus, and it says get insurance, title and closing, better attorney match, learning center, and then better agent match. And it says for agents. So this little slight bunny trail. Let's just go there because I try to aim at real estate agents. So let's just see what we got here. Better agent match. Join Better Real Estate's partner agent team today. It says our tech and tools are making it faster, easier, and cheaper for hardworking Americans to buy a home. Join our Better Real Estate partner agent team to instantly connect with serious buyers exclusively assigned to you. So I can't recommend it. I don't know anything about it. I literally found this article. This is the first time that I've actually done anything with this. So I will be digging into it though, because the article has made me have a lot of questions and to be honest, a few concerns. But yeah, I don't know. Let's see, join today. Does it come with the cost, or is it just a form you fill out and they sell you a bunch of stuff? Probably that. Yeah, I don't see, it's probably referral fee based. That seems like what everybody does. It's like you sign up in their system as a real estate agent and they sell you the lead and you got to pay a percentage off that, whatever. But this is Better.com. So this is what the article is about. And it says like, I want to figure out my home buying budget and all that kind of stuff. Start saving, lower my rate, start my pre-approval. So you can click the start my pre-approval. And it's going to ask you a series of questions. You fill this kind of stuff out, all that kind of stuff. Okay. So this is AI. Looks like it's trying to handle the origination part of it. But this article is going to be more about the underwriting platform. So it'd be fascinating how all this kind of pans out. But let's go ahead and get into this article here. All right. Better's Tinman platform brings conversational AI to mortgage underwriting. It begins with an AI-powered underwriting system developed by Better.com can evaluate mortgage loans in a matter of minutes, and in some cases, seconds, a warp speed that may significantly compress one of the most time-consuming parts of the lending process. I mean, yeah, if you're not familiar, I mean, most of you guys are going to be familiar on here, but just for the sake of conversation, you know, you go to a lender to get a loan, they fill out the application, they gather all the information. A good lender is not just going to give you a pre-approval based on just whatever you say. They're going to validate everything. They're going to pull all of your documents. They're going to get it all before they give you an approval. Just side note, I would find a lender that really, truly does that. That you're not just getting a pre-approval because the buyer told them all the facts they wanted to hear, and then all of a sudden you get under contract, they don't really have a loan. Find a lender that goes farther than that, gathers all the documents. So the mortgage lender gathers everything they need to be able to make a decision. They submit that to some kind of approval internally. They have different ways of doing that. And then the bank looks at all of that information, and then it kicks out the approval or not. The agent gets the approval letter. They go out, they negotiate, they see homes, they then negotiate, they get something under contract. Then you got the contract, the buyer, you send that to the lender. Lender then gathers all the other additional stuff that they need. They wait for inspections, appraisals, everything to get back. They put all that data together. All the stuff that they got from this transaction at the very beginning, they gather it all up. They talk to the title company, and they submit that all over to underwriters. Underwriters basically take all that information and begin to write out the loan. Okay, so that's the process we're talking about. We're talking about that after all the data has been done, inspections, everything's been done, and it's been sent to underwriting. So this article is specifically talking about that, talking about basically doing all that in 47 seconds versus weeks, okay? All right. Better announced the launch of a conversational credit decision engine on March 5th for mortgage and home equity loans, built in partnership with OpenAI and available in ChatGPT. The new application allows lending teams to connect directly to Better's Tinman underwriting engine from within ChatGPT, generating loan evaluations that help lenders approve loans faster and streamline underwriting workflows. All right, let's go ahead and jump on down. It does begin with a title says humans in the loop. It says, according to the company, the Tinman AI platform currently manages more than 1,200 distinct workflows across the mortgage process, including underwriting. In many cases, the system can complete the entire underwriting review end to end. When the AI detects irregularities or scenarios that require professional judgment, licensed underwriters step in. Okay, so we already see a little bit of a lack now. Maybe that gets fixed with AI in the future, but we already see a little bit of lack of what AI cannot do is it can't detect irregularities. In other words, it can't find the nuances inside of contracts and the data, and it's going to require some human oversight. It goes on, it says, quote, licensed professionals are pulled in to review variances detected and for final reviews on any files that require a licensed underwriter prior to funding. Vishal Garg, CEO and founder of Better.com, told Inman via email. Those human reviews also serve another purpose. The feedback is used to continuously improve the platform's machine learning models. So you're kind of teaching it then, right? So what basically they're saying there is if you are one of these people, your corrections is also teaching the algorithm to replace you. It's horrible. It's almost devious. Oh, man. The 47-second underwriting claim. Better says the system can underwrite some loans in as little as 47 seconds, a figure that reflects highly standardized loan scenarios. While there are loans that have been underwritten in as little as 47 seconds, the median timeline to underwrite a typical loan on the Tinman Credit Decision Engine app is 2 minutes and 24 seconds. Still extremely fast. Oh man, that compares with the traditional mortgage underwriting process, which often takes 15 to 21 days, right? This is why we have this 31-day close window. You give a buffer in there. So that's why it's an average 15 to 21 days, and you got some time to do all the inspections, which is typically 10 days, and get all your appraisals and stuff in, all that kind of stuff. So you're looking at 30 days or more. Conventional loans made to conventional loans made to highly qualified W-2 borrowers tend to process the fastest, according to the company. More complex loan files may take several minutes or require a final review by a licensed underwriter. It says some loans take up to 5 minutes or require a handoff to a licensed underwriter for final review, judgment, and sign off. This is made easier by AI doing all the manual work. All right, a tool that supercharges loan officers, so they're not replacing loan officers. Something to take note, though. I mean, are they, it makes me have cause that maybe that's what they're trying to do, though. Because like if I go to better.com, let's just do this real quick. Like if I go to better.com right now and just a quick glance, look, it says buy right there. And it says apply now. Right? So it says apply now. So if I go in here, oh yeah, see, where are you in the home buying process? Let's just say signed a purchase agreement. Great. What is the address of the new property? This is originating a loan, right? Now, more than likely, it's probably going to be patched off to some other lender. Hopefully that's the case here. And maybe there's a lender portal as well. But when you engage with AI, and if you're a lender and agent, when you engage with it, what you do teaches it. So it's just it's a weird time we find ourselves in. It's just really weird. All right. It's okay. I'm just skipping down because for time's sake. This article is going to be linked into the YouTube description. So if you guys want to go back and read this, 30 times better than human underwriters. Rapid underwriting decisions. Somebody ask a comment. I'm sorry if I missed that. I apologize. I'm not used to looking at the chat. I don't think I missed anything. Okay. Guys, do feel free to ask any questions as I go through this. Throw it in the chat if you have something that pops up. 30 times better than human underwriters. Rapid underwriting decisions inevitably raise questions about accuracy and regulatory compliance. Better says the Tinman platform is trained on nearly a decade of institutional mortgage intelligence, powering its machine learning-driven rules engine. The Tinman platform also has a context graph, which has mapped individual mortgage processing and underwriting roles with tasks, actions, rules, and decisions on more than $110 billion in funded loans, over 12 million recorded customer calls, and billions of pages of credit, income, home, and asset level documentation. Like I said, it's learning from us. According to the company, the system has achieved a critical defect rate of 6 basis points, which the company says is far superior to the industry average of 1.8%. That means the platform is 30 times better than human processors and underwriters in terms of loans that are accurately underwritten to investor guidelines across over 40 investors across a broad range of products that all meet the compliance and regulatory conditions that every mortgage needs to comply with. It's fascinating, guys. This is fascinating. All right, now it goes on. The scary part for mortgage professionals. Better's Tinman AI platform illustrates the growing shift toward automation in mortgage underwriting, and the company's claims are backed by compelling data. Some industry observers remain skeptical, though. Colin Robertson, who runs the mortgage news site The Truth About Mortgage, said the headline-grabbing claim of 47-second approvals may be more about marketing than fundamentally transforming the lending timeline. Quote, given the company highlighted 47-second loan approvals, tells you it's mostly a publicity stunt. Who cares if it takes less than a minute to find out you're conditionally approved when the entire process still takes 30 to 45 days? Still, Robertson said tools like Better's conversational underwriting engine represent a step toward a more automated mortgage pipeline. The other side of the coin is the more companies integrate AI, the closer we get to that automated, streamlined mortgage loan experience from start to finish. Robertson noted that the shift could have significant implications for the mortgage workforce if automation continues to expand into underwriting, loan processing, and document verification. The scary part, if you work in the industry, is that the goal is clearly to replace humans with automated workflows, no different than Waymo ditching drivers, Robertson added. So this is a conversation that we're probably going to be having for a long time in regards to every industry and ours and every other industry out there. And there is a scary factor there. But, and again, a big but is that we're there to support people with human connection and emotions. Sure, this stuff can streamline a lot of those things. And yes, there will be jobs replaced. But the job that is on the front line, dealing with people, navigating complex situations is always going to be relevant, is my position. You just can't escape the human element. We are emotional creatures that require guidance and security and conversation to work through these type of things. It's really hard just to sit down and just let something else just read through it and address my my worries and my fears. It's not going to be the same as connecting with somebody, helping me navigate that from their own personal experiences. So we read all this kind of stuff to keep informed. We don't read it to be scared. We do read it to then also navigate and make adjustments and corrections. But we, again, don't operate with fear. Been doing this for a long time. We will find a way. It's just what it is. So there you go. As far as action items, I always like to give action items. To be honest, my simple action item here is read up on this kind of stuff, explore it, stay informed, but then try to keep your own worries in check and realize that it could be just a lot of noise. That, there's a lot of things being streamlined with AI, but keep serving clients extremely well and you'll always be relevant. So that I would just be very, very informed. You could take it a next step farther if you wanted to. Maybe have conversations with your local lenders you work with. Maybe even talk to them about like what they're doing internally for AI, what their thoughts are. When we start talking about this, it's easy to go into AI and ask it these questions. Like, what do you think? Do you think AI will replace, mortgage lenders and underwriters? To be honest, I would rather have a conversation with an actual lender and underwriters to find out exactly what their thoughts are. Because here's my suspicion. My suspicion is a lot of AI is already being integrated into banking. In the underwriting outside of what better.com is arguing for. I have a feeling that internally banks are making these moves already, regardless of what better.com's doing, and they're implementing AI, but they're keeping the person in the forefront. It's kind of like the whole Walmart self-checkout thing. The more you go, the more you begin to see that there is, less and less actual cashiers. It's more and more self-checkout. And, when they first started coming out with that, it was like, oh, it's going to replace people's jobs and that kind of stuff. Well, it actually streamlined Walmart's processes and their employment is actually not lower. It's actually increasing because now you've got this quick urgency to deliver. So you took the people that were doing cashier work and now they are driving, going out and loading people's cars with all the groceries. So now you got more workers that are going through the store, picking their stuff up. And now you're starting to see drivers of cars delivering the stuff. And so you see all these things, right? It's like, yep, okay, that replaced one position, but then we adapted because guess what? People still need to work. People still need jobs. They still need to make money. So it's still going to be a factor. It just shifts around a little bit. But being informed and knowing what's going on, I think that's always good. All right, let's go into a brief conversation about mortgage rates right now because they have spiked a little bit. When we start talking about that, go back 2 weeks ago, it was 5.99. It jumped up to 6.41 today. So let me just share my screen real quick. This is Mortgage News Daily. I talk about it all the time. Download the app, all that kind of stuff. But real quick, the mortgage rate today is sitting at on the 30-year fixed rate range is 6.41, which is up 0.12%. So yeah, it's up. And your 15-year is 6.0. So everything's kind of above 6 unless you get into like the more, fancier type, ARM type loans or the government funded ones like FHA or VA. They drop below 6, but they're right close to 6. So yes, they're up. That is what we're seeing. A lot of this has to do with the Fed rate, and what we're seeing the Treasury yield do in response to the Iranian war. I don't want to use war. The issues going on there. I mean, it's kind of war. We're bombing and there's a lot of bombs and stuff being dropped. So it's obviously driving prices up because of oil and all that kind of stuff. Definitely a war, I guess. But anyway, so that's all kind of happening. So that's where we sit. So let's jump now into the actual conversation. This is an article by CNBC. It says mortgage rates surge to highest in September, hitting spring housing market. It says the average rate on the 30-year fixed loan hit 6.41 on Friday. Just 2 weeks ago, rates had dropped to match a multi-year low, briefly touching 5.99. Okay, we all know that. We talked about that here. It says mortgage rates surged to their highest level since September on Friday as bond yields moved higher due to the war in Iran. The average rate on the 30-year fixed rate loan hit 6.41, according to Mortgage News Daily. That is the highest rate since the first week of September, but still below. And this is the whole thing, right? We're going to see these fluctuations, but do we get alarmed? I mean, we expect this in a cyclical market where, economy rises and falls all day long, every single day, or, certain things can break out and cause different problems like the war, right? They're still below the historical average of 6.78. Or not historical, but what we were at last year. Sorry. That 6.78 is what we were at this time last year. So we're still below that amount. Mortgage rates loosely felled the yield on the 10-year U.S. Treasury, which was up again Friday. Okay, this is counterintuitive for those who expect bonds to serve as a safe haven in times of uncertainty. But when war has a direct impact on inflation expectations, it's more than enough to offset any of the safe haven benefit that might otherwise be seen, wrote Matthew Graham, Chief Operating Officer at Mortgage News Daily. there's that company. Even as rates began rising last week, mortgage demand from home buyers rose, according to Mortgage Bankers Association. But this week's new surge could put a damper on the spring season, which is already plagued by other major headwinds. So here's the thing. There's a lot going on. This type of stuff has happened. We saw the interest rate drop below 5.9. We're now up to 6.41, but yet we still see a high demand for mortgages. So again, just more people are okay. Like they're more settled in. They got a lot of equity, so they're rolling money around. They realize that this interest rate is probably going to stay close to what it is now. It's probably not going to fluctuate too much. It's going to go ebb and flow. The reality is if it does go way down, you can always refinance. So again, it's not like you're stuck at that rate. So there's factors at play here. And there's not like we have to be locked into all this. It's just a fluctuation given the information, right? And really that's kind of it. We don't really need to hash that anymore. I just wanted to touch on the mortgage rate just really briefly to kind of talk about that and go from there. Let's see here. Yeah. So that does leave us enough time to get into the final article for the day. And this article, I talked about this at the very beginning before I started the live show. We've been talking about this whole Compass, Redfin, private listing networks, good, bad, ugly, National Association of Realtors response, Zillow's response. This is going to be the topic probably for the entire year. Is like what makes the most sense. And I don't want to labor on giving you guys the background. You can go back and watch my live streams. I'm having this conversation because it is playing out on the national level. It's no different than we go back a couple years ago talking about the buyer rep agreements and the lawsuit against NAR and all that kind of stuff. These type of things are, and I'm not going to say this is like a major disruption. I won't go that far. I think it's just disrupting some of the status quo that we've always known. And the simplicity of is our status quo was we go out, we are required when we're part of the National Association of Realtors, we were required to have it on the market, on the MLS within 24, 48, 78 hours, depending on your MLS rules and regulations. And then it had to syndicate everywhere. In other words, the seller or myself or the agent could not decide where to market that property. The moment you listed it, you were required to put it out there and it go live everywhere. All right. So that's been the way we've done real estate for many, many years. With all the stuff that's happened the past couple of years against NAR and they're, being found guilty of the collusion type stuff, which I beg to differ. But anyway, all of that kind of stuff has caused NAR to take a step back and really not put too much pressure on the individuality that the brokerages do have and gave them some freedom and autonomy, even though they're still part of the National Association of Realtors. Now, there are different rules and regulations that we have to follow inside of every single association in your market. So you got to know what those are. But there's a massive conversation happening. Compass has pretty much started that because they have this entire network of off-market listings where the listings are marketed into their own private network. Well, just a couple weeks ago, Compass goes out and negotiates a deal with Redfin, which is Rocket companies, Rocket Mortgage and Redfin. And they negotiated a deal that all of Compass's off-market listings would be also syndicated to just Redfin as an option. And then those the leads generated by those off-market listings would go directly to the listing agent. So that's the deal that they negotiated. Let's keep in mind, Compass now is the largest brokerage that has the most agents underneath it. Massive, hundreds of thousands of agents are now underneath the Compass Holdings Company, which just bought out Anywhere that owns Century 21, Coldwell Banker, ERA, Cochran Group, all of those, Better Homes and Gardens, all those companies, including their own Compass brand, right? So a lot of agents are associated underneath Compass. So there's a massive move here. And it's a power play, to say the least, but it's also a strategic one. And I found this article this morning, and I was like, you know what? We're going to hash this out just a little bit more because what's happening in this article is Redfin has put out the methodology of what the inventory impact of phased marketing is. All right. So there's the stage. I've got 12 minutes to go through this stage with you guys because I don't want to go over an hour. I've got meetings I got to get on. So here we go. This is the article. It is literally on redfin.com. It's under their news category. So if you go, let's see, company news right there, and it drops down, you'll see it all in there. Okay. It says this methodology accompanies Redfin's report about how letting home sellers test the market before officially listing could boost housing supply. Okay. Now, remember, Redfin's writing this article, so yes, it's a slight opinion piece, but let's just dissect this just a little bit. Every year, many homeowners are discouraged from selling by the high costs and uncertainty associated with listing and selling a home. These effective costs include both direct expenses and other factors that effectively reduce the seller's net income. Direct financial costs. Okay, so think about this. You go in, you list a property, you go in as an agent, you inspect that property. Typically, a seller might ask you, what all needs to be to this home to get it ready or increase my value? What should I not do or what should I do, right? They ask these questions. So the direct financial cost to a seller is they got repairs they need to make. They have staging, real estate agent commissions, and taxes they've got to do, right? Those are real financial costs. Time and effort costs. In other words, the time required to prepare the home, coordinate with agents and buyers, accommodate showings, right? It disrupts their home. So the larger of an audience it goes out, the more it's inconveniencing the sellers. Market outcome costs. The risk of receiving lower than expected sale price, extended time on market. In other words, longer time on the market, lost income from doing so. Privacy and disruption costs. Loss of privacy from showings and market exposure, and loss of full use and enjoyment of the home. So these are all arguments when you start talking about going and pushing out a property massively to the masses. Okay? If I go in as an agent and I go in and I start trying to price this home correctly, give them advice on what needs to be done, all the repairs and staging, everything that needs to be done, then let's say I don't price it right because I don't have enough data to come up with the correct price. So then their home is on the market longer, right, than it could have been. Then you have this long time where they're sitting on the properties on the market being exposed to massive amount of people. So now their life is disrupted for a longer period of time to the broadest audience possible. Okay, so this is the scenario that they're arguing, like, is this really the way we do things the best for the seller? That's the argument. So I can make this just a tad bit bigger here. All right. This analysis focuses on two ways phased marketing specifically the ability to test pricing and collect feedback from buyers before listing on an MLS or control market exposure can reduce some of these effective costs. Okay, so this is the whole entire argument that Compass is having. Is they keep talking about you as an agent owe your fiduciary responsibility to your seller. You don't owe it to the National Association of Realtors. You don't owe it to the MLS. You don't owe it to Zillow or all the portals. You owe it to the seller. So the argument here is talking about how this phased marketing approach is beneficial for the seller. Now, I think it was like Wednesday of last week, I found an opposing view to this. And the whole entire time, the coach that wrote the article was talking about it as the benefit to the agent and how the agent loses out on the marketing to gain more leads and that kind of stuff. It was so agent-centric. The argument was for the benefit of the agent and the brokerage, not the seller. And sure, I would agree with the coach's opinion that, yeah, for us, it makes really good sense for us to market this out everywhere, right? The more eyes I can get on it, the more buyers I can attract, the chances I can increase my leads that won't even actually buy that house, but just more buyers that I can get to then go sell them another house. Yeah, I would agree. It benefits us. That's not Compass's or Redfin's position, though. We estimate that these benefits are worth 1.2 to 2.4% of their home's value to sellers. We created a model to estimate how sellers would respond to these benefits and estimate that phased marketing could increase annual listings by 6 to 12% in markets where it is widely available. Background. As Figure 1 illustrates, sellers and their agents under the traditional marketing model must decide on a list price prior to listing the home based on limited information such as comps or recent sales of comparable homes. And in a shifting market, you have less and less comparables. There's less homes on the market. And if you're in a rural area, good luck. Most of the time, you're guessing what the price is going to be. It's like, well, I found one home that fits the criteria of your house, but it's like 4 or 5 miles down the road or 10 miles down the road in the same county, but just pretty far away. Or I found some homes, but they're a year since they sold, not 6 months or 3 months, right? So now we're trying to pull these comps. We don't have enough comps. Upon choosing a price and listing the home, days on market and all price changes are public information moving forward. In other words, the whole buyer consumer knows that you overpriced that home, and it adds a stigma to that house, doesn't it? So they go in and they say, well, this person already reduced it $50,000, right? I'm gonna go in and make them a low ball offer. They've overpriced it. Price uncertainty can lead to a range of outcomes. So here is the homeowners interested in moving, okay? This is the graph. It says decide to list. They consider the cost and the benefits. Prepare listing. They determine the price. Home publicly listed. Okay, so that's that long graph right there. It says overpriced. Longer than expected days on the market, risk of price drops. Okay, so if you decide to list, you prepare the listing, and you publicly list it, and you overprice it, now you've automatically added days on the market. And now you got to start reducing the price. Okay, next one is decide to list. You consider cost and benefits. You determine the price. Then you accurately price the home. In other words, you get it right. Expected days on the market. So you get what you kind of expected. Maybe it's the average days on the market you hit. And then you get a fair sale price. The next one is consider cost and benefits. You go in and you determine the price. You underpriced it. Faster than expected days on the market. So this is the counter. You left money on the table. Risk of low sale price. In other words, your seller now lost money. So the question I have to ask is, how good is the agent at truly pricing the home correctly? Do they price it every time extremely well? The answer to that is no. No, they don't. The market shifts so fast, it's really, really difficult for agents to price homes correctly. Then the other thing is then when the market is accelerating, we underprice it and we lose money for our sellers. We hardly ever accurately price a home. So the argument is this: the next option, consider cost and benefits, choose not to list, then uncertainty dissuades some listings. Now we get into the argument, right? So now we get into the whole thing about distribution of sellers by pricing accuracy. And we get into the whole conversation about how we can use this soft marketing, this smaller marketing pool, to make corrections to the market before we start giving historical data out to the portals, right? Sellers and their agents typically decide on a pricing strategy based on how the seller values time, sale price, and convenience. Some sellers may prefer a quick sale and aim to price cautiously to avoid the risk of extended time on the market. Other sellers may prefer to maximize their sale price and aim to price optimistically, even with the likelihood of longer time on the market. But only with the benefit of hindsight do sellers learn how to accurately they have priced for their strategy. The first few weeks on the market provide crucial feedback to sellers, and it does. Here's the thing, in historical data, the first 2 weeks of any property going on the market tells you everything. If you don't get any activity and you don't get any offers, guess what? Overpriced. If you get tons of activity and you get a multi-offer situation, guess what? Underpriced. If you get on the market and you sell it within 2 weeks, price right. Okay? That's the thing, is if you're trying to sell it, you're trying to find that sweet spot. Now, you can make repairs, you can do certain things, but how do you know? The most crucial time in a listing is the first 2 weeks. Every agent knows this. I go out and list a property. The first week, I'm gonna get all kinds of calls on it, get people through it, and then nothing happens. I then have to go back to my seller and be like, hey, yeah, we had like 10 showings, not a single offer, you're overpriced. Then they're also gonna be like, then you have this whole other conversation. Well, we really need that money. I can't afford to go any less than that because we need that money to roll over into another property. Because remember, we've got an affordability gap problem, right? So then what's the conversation? Well, let me tell you, you probably need to increase your curb appeal. All right, so how much is that gonna cost? Well, you gotta put some landscaping here. Maybe you gotta, pave your driveway. Maybe put a sidewalk in, whatever. Now you gotta, declutter your house. Okay, what do I gotta put? I gotta now have a yard sale. I gotta do something, right? My home's in the market though. How do I declutter while the home's being shown? All right, another problem. Now, you probably should repair and you should make these repairs and fix these things. Okay, am I actually going to recoup my money? Well, maybe. I'm going to try to guess. I'm going to go off some comparables and see what I can do, right? But now I've lost my 2 weeks. Now my seller is now in a position where it's listed. Buyers are still seeing it. We're going to make all these type of things. And then how do I tell everybody that all the repairs and all this kind of stuff's been done? Oh, I got to go out and spend more money on on photos to update the outside pictures. I got to go inside and do new photos to update the way everything looks. They got to fill out the new seller's disclosure to disclose all the things that they repaired. And then we got to put it back on the market. And now I've got to market it again and let everybody know that all these things have been done. Right? All takes time. All right. How significant is the risk of mispricing? One way to measure pricing accuracy is to compare the initial list price of a home to its eventual sell price. A home that was initially priced much higher than its eventual sell price was likely overpriced. A home initially priced much lower than its eventual sell price was likely underpriced. So this is that figure here, figure disruption of sellers by pricing. Underpriced is plus 10%, underpriced 5 to 10. Share of, well, this is a graphic. Go back and read this. I'm running out of time. Sorry, guys. Oh, goodness. Okay, estimation of phased marketing value and effect on listings. All right. We model phased marketing as benefiting sellers through 1, improved pricing accuracy, and 2, improved privacy and convenience. We assume that pricing accuracy is improved by allowing sellers to test prices and collect feedback from buyers without a public price or time on market history. And privacy and convenience is improved for sellers who prefer discretion or want to limit the number or pace of tours. We calculate the following values to estimate the value and inventory impact of these benefits. The share of homeowners who stand most to benefit from phased marketing through improved pricing accuracy or privacy and convenience, the average benefit as a percentage of home value for these sellers, and the percentage increase in annual listings given those cost reductions. And so this does give us a breakdown of what all that looks like. But you kind of understand the argument here. I don't have time to go into each and every single one of these arguments. But on the surface, you get what I'm talking about. You see the benefit here. I'm not saying that the other side has it wrong. There's an element to what they say as far as the data given the best chance, and the more exposure you give to a property, the better. There is absolute argument. So this whole methodology is not for every single seller, but there are cases where this makes sense for a seller. And it gives you time to even get your own sphere of influence, your own core agents in your office through the property and get their eyes on it to see what might need to be done and give their recommendation. And it gives your seller time to make those corrections before you mass market it. So there's just an argument to have on both sides. Where do you land? Let me know in the comments. But I think this is a plausible argument for this case. Like, again, I understand the argument is like, for me as an agent, I want my seller to broadcast their property everywhere as fast as possible, right? Selfishly, I do, because the more eyes, the more chance of in my lead pool is. Very simple. The more eyes I can get on it, the more chance I have to increase my leads. Also, you can make the argument, say, more historical accurate data. So when I am trying to pull comps on other properties, I don't have this skewed data out there. So that's a fair point. Appraisers make that point. It's a fair point. But again, we go back, is our fiduciary responsibility is to the seller. And if I can go into a meeting with my seller and I have options before them, and as I'm having that consultation with them and they're talking about their situation, I'm looking at the home objectively, I'm thinking through all options before them of what they can do to best position that home to be sold for the maximum amount of money. And having this kind of marketing potential in my back pocket gives me a conversation that I can have with them that I've not had in the past. So that's why I think there's a conversation here that needs to be hedged out. Now, in the end, you can only do what your local and state laws allow. You can only do what is regulated and permissible by the National Association of Realtors and the association you're a part of. So you definitely adhere by them, and you should absolutely do that. But you should also be very much aware about what's going on in this conversation and how to help your sellers navigate it and what all their options are, even though you might know all those policies and that kind of stuff, and help them navigate it. So this is a good conversation to have, guys. It's just a good one. It's something to be informed with. Hopefully you found that valuable and you did get some information on this. And it has helped the conversation a little bit. So when you start reading headlines about this and you start seeing the opposing views on all sides, you got a little bit more clarity about what's going on. Because there's a lot going on. There is a lot going on. All right, guys. 9:34, wonderful. Thank you guys so much for being here. Just so you guys know, I live stream Monday through Thursday, 8:30 a.m. Eastern time, right where you're watching me now. I do greatly appreciate you guys joining in and watching me and listening to me and engaging with me. I appreciate that. I love all the DMs that I'm getting. I'm starting to get more and more of those. I appreciate those. They help me find articles, that kind of stuff. We're really starting to build a community here, and I just greatly appreciate that. So I'm excited. I'm excited to be sitting here talking about this. I don't have all the answers, guys. I read the news. I pull some opportunity out of it. I apply some of my own logic and my own experience to that. But there's a lot of experience out there too that's listening to me talk. You're welcome to engage with me. You're welcome to bring articles up. You're welcome to push back even on what I'm saying. Like I invite that. We all grow that way. This is just part of my daily process. So with all that being said, I got to wrap this up. So that is your real estate brief for today. If you found this helpful, please consider hitting the like button and also following me to tell YouTube and TikTok you would like more of this type of content, and consider subscribing to join a community of real estate agents that are focused on building a business that is relationship focused first. Thank you guys so much, and I will see you in the next live stream. Take care. Peace.